Welcome to this video on Options 101, where we explain calls and puts simply. We will walk through two stories to help these concepts click, and then look at the trading mechanics behind them. Please note that this video is not financial advice. In this masterclass, we will cover the basics of options. We will start with a story for call options, then one for put options, dive into the real trading mechanics with a $50 stock example, explore the differences between buyers and sellers, and finally, put it all together. The core idea is simple. An option is a right, not an obligation. The buyer pays a premium for the choice to act, with risk limited to that premium. The seller collects that premium and takes on the obligation to honor the contract if the buyer chooses to act. At a glance, a call option is a bet that an asset's price will go up. It gives you the right to buy at a fixed price. A put option, however, is a bet on a price decrease, or it can be used for protection, giving you the right to sell at a fixed price. Now let us begin Part 1, Call Options. We will follow a story about a house to help you understand how to read a call option like a pro. Susie is selling her house for $500,000. Nearby, a vacant lot is for sale. Two developers, Peter and Harry, are interested. Peter's plan for a park would likely increase the house's value, while Harry's plan for low-cost housing could decrease it. Enter Sammy, a potential cash buyer. Sammy wants the house, but he will not have the funds ready for 3 months. He worries that he might lose the property to another buyer in the meantime, so he needs a way to lock in the price now. Sammy makes a deal. He pays Susie $5,000 now for the right to buy the house for $500,000 at any time within the next 3 months. If he exercises his option, he pays the full price. If he walks away, he loses the $5,000. This agreement gives us 3 key terms. The strike price is the $500,000 purchase price. The premium is the $5,000 paid for the right. Finally, the expiration is the 3-month deadline after which the right disappears. In Scenario 1, Peter buys the land, and the house value rises to $600,000. Because the house is worth $100,000 more than the strike price, Sammy exercises his option. His net result is a profit of $95,000. In Scenario 2, Harry buys the land, and the house value falls to $400,000. Buying the house at the $500,000 strike price makes no sense, so Sammy walks away. He lets the option expire, losing only his $5,000 premium. In Scenario 3, nobody buys the land, and the house value stays at $500,000. Since the value is roughly equal to the strike price, it is a toss-up for Sammy. He can choose to buy or walk away, with a maximum loss of $5,000. This table summarizes the 3 outcomes. Regardless of the scenario, the shape of the bet remains the same. Sammy has unlimited upside if the house value climbs, but his losses are strictly capped at the $5,000 premium. The big idea here is control. By paying just $5,000, Sammy controlled a $500,000 asset. This illustrates 2 core features of options: leverage, which allows exposure to upside, and defined risk, since losses are capped at the premium. Finally, consider the seller's perspective. Susie is happy with this deal because she receives guaranteed income, she does not face pressure to sell immediately, and she considers holding the house for 3 months in exchange for the premium, a fair trade. Now let's consider what happens if Susie expected a quick sale. In that case, she would have demanded a higher premium to take her home off the market for 3 months. This illustrates a core trading principle. The greater the expected move in an asset, the higher the premium the market will demand. Translating these concepts to trading, a call option is a contract between 2 parties to exchange stock at a set strike price on or before an expiration date. The buyer holds the right, but not the obligation, to buy, while the seller takes on the obligation to sell if the buyer exercises. Let's walk through a real trade. Imagine a stock trading at $50. You expect it to rise to $60, so you buy a $55 call option for 20 cents. Here, your strike is $55, your target is $60, and the 20 cents is your premium cost per share. If the stock rises to $60, you win. Your call gives you the right to buy at $55, resulting in a $5 gain per share. After subtracting the 20-cent premium you paid, your net profit is $4.80. The seller is obligated to fulfill this, taking a corresponding loss. Conversely, if the stock never reaches $55, you lose only your premium. The option expires worthless, because there is no reason to buy at $55 if you could buy cheaper on the open market. The seller, in this case, keeps that 20-cent premium as pure profit. In summary, call options are a bet that an asset price will rise. The buyer's risk is strictly capped at the premium paid, while the upside potential can be significant. Remember, in every options trade there are 2 sides with mirror outcomes. There are 3 key things to remember about calls. They are bets on an upward price move, the buyer's risk is limited to the premium, and there are always 2 sides to the trade with mirror outcomes. Now we move to Part 2, Put Options. The easiest way to think about puts is as an insurance policy. Let's look at a story about a truck to explain. Sammy owns a truck worth $40,000 and worries about theft or accidents. He wants to protect its value, which establishes our strike price. The potential for accidents or theft represents the risks he is looking to insure against. Sammy buys an insurance policy for $1,500 a year. This policy acts exactly like a put option. The policy itself is the put, the $40,000 is the strike price, the $1,500 is the premium, and the one-year term is the expiration. In scenario 1, if the truck remains unharmed all year, the policy lapses. Sammy never files a claim, and the insurer pockets the $1,500 premium as profit. Sammy pays the cost willingly, for his peace of mind. In scenario 2, if the truck suffers $10,000 in accident damage, Sammy files a claim. The insurer pays for the repairs as agreed, honoring the protection. The put has successfully done its job for Sammy. In the worst case, scenario 3, the truck is stolen. This is a total loss, and Sammy exercises his protection for the full $40,000 value. He is made whole again, which is precisely why he purchased the policy. Ultimately, a put option provides downside protection. It is designed to pay off specifically when the asset loses value, offering a financial safety net exactly when it is most needed. Selling puts can also be profitable. Just as an insurer collects premiums from many drivers, most of whom never file a claim, a put seller collects premiums that often outweigh the occasional payouts. It's about collecting income across many contracts. Premiums for put options aren't arbitrary, they scale with risk. If the underlying asset has higher perceived risk, the insurer or option seller will charge more for the coverage. Conversely, for a safer asset, the premium for the same protection will be lower. In trading terms, a put option is a contract where the buyer holds the right, but not the obligation, to sell an asset at a specific strike price before an expiration date. The seller, however, takes on the obligation to buy the asset at that price if the buyer exercises. Consider this trade. A stock is at $50. You believe it will fall, so you buy a $45 put option for 20 cents. Your strike is $45, your target for the stock is $40, and the 20 cents is your premium cost per share. If the stock drops to $40, you win. You have the right to sell at $45, creating a $5 gain per share. Subtracting your 20-cent premium, your net profit is $4.80 per share. The seller, meanwhile, must buy the stock at $45 and takes the loss. What if the stock doesn't fall below $45? The put expires worthless, because it makes no sense to sell at $45 when you could get more on the market. In this outcome, the buyer loses the 20-cent premium, while the seller keeps that premium as pure profit. In summary, a put option buyer is typically betting on a price decline or seeking protection, with risk limited to the premium paid. A put seller acts like an insurer, collecting premium income, but taking on the obligation to purchase the asset if exercised. Now that we have covered calls and puts separately, let us put it all together. We will compare them side by side to see how they function within the broader options framework. Here is the master comparison. A call option gives the right to buy and is used for bullish views. A put option gives the right to sell and is used for bearish views or insurance. Both offer defined risk for the buyer, equal to the premium paid. We can group these into 4 core positions. Long calls are for bullish upside, while short calls are for neutral to bearish income. Long puts are for bearish downside or hedging, and short puts are for neutral to bullish income. These are your building blocks. What drives an options premium? 4 factors: the expected move of the asset, the perceived risk of the trade, the time remaining until expiration, and general market volatility. Each plays a role in how expensive or cheap an option contract becomes. The buyer's superpower is defined risk. Because the most you can lose is the premium, you know your worst-case scenario before entering a trade. Sellers face larger, sometimes open-ended, risk, which is why they usually require more sophisticated management. Avoid these 5 common mistakes: assuming all options are good bets, ignoring time decay, confusing rights with obligations, viewing cheap premiums as inherently safe, and selling options without understanding the open-ended risk involved. At Hollow Point Trading, we analyze trades through 3 lenses: the macro environment, the fundamental drivers, and technical structures. Never rely on a single indicator. Always consider the big picture before you act. To wrap up, calls are for buying, puts are for selling or protection. Buyers hold rights, sellers hold obligations. Risk for buyers is capped at the premium, while premiums themselves depend on market forces. Every trade has 2 sides, and one side's profit is the other's loss. Finally, here is a quick glossary for your reference. Keep these terms handy as you continue your journey in options trading. Thanks for watching and good luck with your trading. Welcome to Hollow Point Trading. We provide structured education and a macro fundamental technical framework designed for real-world markets. You can find our live callouts, lessons, and more on our YouTube channel, our official website, or by following our Substack. Stay updated and keep learning with us. Before we begin, please note that this material is for educational purposes only. Options trading involves substantial risk, and this is not financial or legal advice. Always do your own research and consult with a licensed professional before making any investment decisions.